Diane, like Steve said, Barclays just goes to 50. Look, yes, the jobs report was way better than expected, but don't you worry a little bit about the fact that we've now had 2 bank collapses in a week?
We certainly worry about the stability of the financial system, and the Fed worries about that as well. And we've been watching very closely the Treasury market. The Treasury market has not been as liquid as it was pre-pandemic since March of 2020. So that is something we've been watching. That said, that's been the case for some time. And where the economy stands right now, unlike where we were back during the financial crisis, we are in an inflating economy where inflation looks like it's getting sticky, and demand continues to come in very strong, even if we were to see ripple effects from this, and we have to see how far they are. But I think the most important issue for the Fed right now is 815,000 new paychecks since the start of the year, along with the largest bump in Social Security in history. Those two things are keeping the economy extremely strong in the first quarter and buoying demand, which is what they're worried about, keeping inflation high. Even though wages slowed, when you're generating this many paychecks, it's buoying domestic demand. And the data in the retail sector, we saw retail hiring picked up. That hiring actually was against a backdrop, again, of labor hoarding, where they didn't lay off as many workers as usual in the retail sector, in traditional department stores and big box discounters. That's also an area where we saw entry-level wages were boosted by one of the largest retailers out there as we got into the month. That will be showing up going forward. The retail wages in that sector went up 1.1%, defying the other wage deceleration we saw. I think all of that is important because it points to consumers. We know baby boomers shop more at traditional retailers. We had the largest surge for monthly increase in traditional department store sales in January on record outside of reopening. So this is still a very, very robust economy that's too hot for the Fed. And if they were to ease preemptively before we got into an actual financial market seizure, they could trigger a much more systemic rise in inflation. That's not where we were in previous financial crises.
Very well said, Diane. So, Rick, I turn to you and ask the question, do we face a trade-off between systemic risk, systemic financial system problems, and systemic inflation?
I personally don't think there's a lot of either, to be honest with you. I think what's going on with the Silicon Valley Bank is important. And I think that when you have the biggest punch bowl in history, nobody should be shocked that when central banks turn the lights on, and the punch bowl slowly gets removed, that there's going to be fissures and cracks. We should expect those. Anybody who thought this was going to be seamless and a perfect soft landing, I just don't think it's possible. And in terms of systemic inflation, I don't believe that either. And I'll go back to the boring analogy that when you shut down an economy the way we did in March of 2020, even though it was 3 years ago, I think when you turn it back on, that things take a while. And for any presidential administration to take credit for these jobs, to me, is silly. You shut down the world's economy, you open it up. Jobs are going to come back all by themselves. And the process is just like inflation, not linear, very bumpy, and not even. But the thing that if we did 25 basis points or paused and stayed where we're at, that's somehow going to fuel more inflation, I don't buy into it. I'm not saying Diane is incorrect. I'm just saying it doesn't reflect my opinion, and I certainly don't think it reflects what's going on with the spreads.
Let me add one more voice here. Kim Forrest joins us from Bokeh Capital. Kim, and maybe, let me add, listen, we all know you're highly focused on tech performance in particular. I'm curious if you then are reacting to what's happened with Silicon Valley Bank, thinking it's maybe worse than many, or actually thinking, it's not that big of a deal and maybe there's other factors you're focused on today?
Well, I think it's a huge deal if you have money over $250,000 there. I mean, end of the day, right? And even in 2008, my mind, when banks were teetering on the verge of collapse, my mind was always, what happens to people's payroll? Because that comes in from other banks, many other banks in many cases, and sits there for a while, and people won't get paid. So that's something that I think FDIC has to really concern themselves with. But I'm in Rick's camp where this is probably sequestered, but I think it highlights we are lousy as investors at forecasting much other than what's right in front of our nose. And like one or two hops down the binomial expansion of what can happen next, we're terrible at forecasting. And I think, well, I hope the Fed understands this, and that's why they adjusted their rates down to 25 basis points, so they could have time to collect themselves and make decisions when these issues pop up.